So we are in part 2, the update on December 11th. So I look at historical bear markets. In blue I have the average of long bear markets, and in green I have the average of short bear markets. And as you see, these long bear markets, they have kind of a consolidation phase here before we have the capitulation, and the short bear markets, they rally. So we are at this critical point where either it's this long-term downtrend that is working, and you know, these bull markets, these bear market rallies, they tend to go up around the falling trend line and around the 200-day moving average, and sometimes they even break above the trend line and the 200-day moving average, but still they break down again and continue the bear market. But when we break these resistances, when we break above trend lines and 200-day moving averages, that's a warning sign that it could be bullish. But you know, now we have pulled back a bit again. So is it the falling trend line that dominates, or are we in the new bull market? And I'll skip these bear markets and I'll look at short bear markets where we start to rally. Well, we could have just a quick look here comparing with 2007 and 2000. We see this is about the time where we have a steep drop. But looking at the short bear markets, I have marked this bear market rally where we are here now. So comparing with 53, at this point we had broken above this trend line and consolidating a bit and then continuing the uptrend. And 61, here we had broken above, we consolidated a little bit and then we rallied on. Similar here, broken above trend line, consolidated a lot before we continued to rally. And we have 2015. At this point we were just about to break above the trend line and consolidate a bit more. Yeah. So at this point where we are now, we still haven't broken this trend line. So time is kind of running out, but you know, with the Fed coming this week, we could have volatility, we could pop up here and consolidate above this trend line and then rally on. So anything is possible. Let's see if we go back. These are some bear markets, and they are measured not from the price high but from the cycle, from the 7-year cycle. Yeah, not much to conclude there. I've often been looking at this bear market from 73, 74. That's the most similar one. And this one, well, this one could allow for a rally into New Year, or sideways into New Year, but I wouldn't conclude much there. So we are above this 80-week offset. That mostly has been a nice working signal. We haven't broken above it yet, so we are still below, and still in place we have a downside target below 3000. But then we have another offset, and that's the 21-month offset, the half of the 42 or half of the 3.5-year cycle. And this offset we are back above, but we could break below again here. So you know, either we have to go up or we have to go down. At some point we will go up above here, but do we first need to go back below and have the capitulation? So my opinion here, of course, is we should have the capitulation phase, but have to see. Yeah, cycles pointing down, but what about the 10-week cycle? That one is going up into New Year. And the seasonality also bullish from around December the 15th and into New Year, or a bit into January. So, well, my scenario here is still this red scenario. I have put in, as you see, a pop up here around just before New Year, but that should be a shoulder, I think, and then we go down into say late January. But I think maybe the 10-week cycle could prolong this into mid-February. Yeah, we'll see. See you in the next one.